Okay, we are back. So some real technical difficulties. And if you tune in every single week, you know that, I'm probably not the most tech savvy person in the world. So we had a little bit of an issue, had to restart the live stream. Well, we're just going to do the best that we can with what we've got. How's that sound, you guys? Annie, Noah, sound good?
Love it.
Yep. Makes you appreciate SNL, doesn't it?
Totally. Well, I appreciate your patience. So thank you guys for hanging in there. As I mentioned earlier, if you caught the very first few seconds of our 60-second live stream, my name's Andy Green with Green Group Real Estate at Keller Williams Realty Professionals. I'm joined, as always, by Annie Ransom with All Pacific Mortgage, and we have got a very, very special guest today. Noah Blanton, he is the president of WFG Title, a great partner of ours. Always have done a great job, go above and beyond, and Noah's really looked at as one of the thought leaders and understanding the economics and just everything that goes into real estate. So we are going to, without any further ado, we're going to dive into it, and we're just going to have a real candid conversation with you, Noah. Does that work for you?
That works for me. I am not afraid to be candid.
Okay. I love it. Well, let's just start off by talking about where were we heading into this whole COVID-19 as far as unemployment, the economy, what was happening in our local market here in Portland, Oregon?
Yeah, so we were coming off of the largest and longest expansion in the metro area's history. And from the trough of the last recession to the peak of our last cycle, which we'll say was mid-2016, let's say, was sort of the peak of the last cycle, we had added 250,000 jobs in the metro market. And we had seen all of our sort of measures of employment hitting all-time highs. The percent of our prime age population that was employed was hitting pre-recession highs. We had more absolute jobs than we'd ever had. And late in 2018 and through the first part, middle of 2019, we took a little bit of what we'll call a breather, and the employment market sort of started to even out. And then we restarted growing jobs again into 2019, let's say the last third of the year. And all through the first quarter of this year, actually, we had grown jobs as well until the whole COVID thing hit. But we had this really strong, nice curve starting up again as we began to add jobs in the metro area again. And our unemployment rate actually fell pretty dramatically in the fourth and first quarter, down to, I think we were about 3.3% in the metro area. And so you really could not have looked at a healthier, stronger job market, I think, in Oregon and the metro market heading into the current scenario that we were in. We were just incredibly healthy heading into this.
Okay. Awesome. So I want to pause for just a quick second, and anybody that's out there watching and listening, if you have any comments or questions that you want us to go over, then feel free to add your comments, ask your questions, and we'll try to get to those here live. My feed does say that there's some sort of a glitch with one or two of the sites, but if we don't get them while we're live, we'll definitely go back and get them down the road. So Noah, in regards to what you just said, the first thing that came to my mind was I've had a couple different knee surgeries, and the doctors always say that the healthier that you are going into a surgery, the faster the recovery is going to be. Is that kind of the same thing in this situation?
Yeah, I mean, I think that the analogy is appropriate. And then if you think one step further and say, well, I'm in good health. Actually, let's say I'm in the best health I've been in the last 12 years or so. And I didn't actually fall and knock my head around or break my leg. It wasn't an accident or an outside cause. I intentionally said, hey, I'm going to go in and proactively do something for myself. And that's really the situation that we're in now. Very, very healthy. We decided we were going to take a step backwards, and we were going to take this medicine, whatever that medicine was. And so then, yeah, I think you could infer from that coming out then, the healthier we didn't have an anemic job market going into this. So
Right.
coming out of it, you'd have to say, well, we'll be that much better coming out. And, that's not the case everywhere. And so I think if you look at jobs markets across the country, Oregon generally tends to do worse in recession and better coming out. We may see that that's not the case as we come out of this recession or go through this one, whatever it ends up looking like. But we're in recession by government fiat, not by some other outside or otherwise, sort of economic influence that we could point to and say, oh, we had a banking crisis or an oil shock, although we have, one of those going on as well, but
Right.
also probably induced by government fiat. So it's very different than anything we've experienced before. But what we do know is we probably look better than we ever have going into it. So
and it seems to be ever changing. It's crazy to me that this is something that has really evolved over just a couple month period of time. It seems like we're still learning new statistics and the unemployment numbers and how, this is really going to affect businesses once we start lifting orders and people head back to work.
Yeah, there's a behavioral component that comes with that as well, which is why I think the state and others have started saying, well, the shape of this recovery may not look like a V or a U or an L or a W or any of these traditional shapes. What's the initial bounce back when we do reopen? Is it 30%? Is it 40%? And then what's the road back to 100%? And it's interesting. Those are hard questions to answer right now. I mean, we started, generally we look at monthly or quarterly data. We started looking at weekly data for the first time ever. You were like, well, let's measure what's going on almost in real time to see how people are reacting. And,
right.
That's been a challenge to figure out how people are absorbing information and then reacting to it. I don't think we have really good information on that other than to look at what people's behavior is,
right.
Specifically. And then, that could lead into looking at their behavior as it relates to real estate.
Right.
Maybe our primary concern due to our day jobs.
Right. Yeah. Well, yeah. And I think to use Andy's injury analogy, right, I kind of look at it like breaking your leg versus spraining your leg, right? We don't have a clean break from this, it's not like it's going away, right? It's a new norm for us to figure out how to manage this and hopefully keep from rebounding again to where our market is affected all over again. So it'll be interesting to see what continues to happen and transpire from it.
Well, let's keep that analogy going, and I think we can also say, and certainly these are not exactly, they don't match up exactly, but
right.
I think the analogy of being ill, the sooner you get back up and start moving. I mean, we know that's the case now. The better off you are, and I do think duration starts to matter a great deal right now. And I think that is an as yet answered question: is what is the duration? Is it 6 more weeks? Is it 4 more weeks? Is it 6 more months? That begins to matter tremendously. So at the moment, I think it's orderly. We know what we're doing. We can see it. We can see the result of it. And at the same time, though, I would say we can also see the quick and swift reaction to trying to help people weather through that, whether it's businesses or individuals. No one can deny that a tremendous amount of effort and help has been put in place to try and help people through this period of time, knowing that it's going to be temporary and short and that it's unnatural. This is not a sort of natural recession.
Sure. Yeah.
We are in a time in our history that none of us are ever going to forget. We're going to look back at this at the end of our careers and have conversations about, remember when COVID, and our kids or our grandkids probably are going to have no reference point outside of maybe in the history books. So this is just unprecedented what we're going through. So honestly, as hard as it's been and some very sad stories through this and the struggle There's also been a lot of overcoming and people coming together and banding together as a nation to do some awesome things. Do you guys feel the same?
Absolutely. Absolutely.
Yeah, for sure. And I would say that, you look at all of the folks that have continued to work and under the conditions that we're in, I'm always surprised at how innovative and creative business can be, and how quickly,
Right,
when we have to, people can adapt. And we are adaptable, and so you absorb the information, and it's only been a few short weeks, and you adapt to it. And that piece,
Yep.
if you'll look for it, is really inspiring. You're like, wow, look how quickly businesses were able to adapt. And notwithstanding, of course, there are a lot that are struggling tremendously, but there's also a tremendous amount of creativity and adaptability going on.
Yeah.
Yep.
I think just humanity in general,
Yep.
Yep, we've definitely seen that in our industry. It was amazing to watch the progression between real estate agents, brokerages, title companies, mortgage, in order to keep the train moving forward. How quickly everybody adapted and changed their processes, their systems, their tech, all of the above. So yeah, it was super interesting to watch that progression. Let's change tracks a little bit, and let's do a little bit of a comparison. So we talked for a minute about what did it look like coming into this, so just prior to, and like where are we at today. Let's go back to the last recession, because Annie and I have been talking about this for probably the past month, at least in bits and pieces. How I think that for the most part, a lot of people have this memory. If they were old enough to live through the last recession, they have this memory of real estate crashing and short sales and foreclosures and just complete chaos in the housing market. So what is your take on the difference between where we were at in the last recession compared to today, Noah?
Yeah, well, as it relates to housing specifically, so we've talked a little bit about employment, but as it relates to housing specifically, it could not be more different. And I think if we look at the last recession, that is probably both yes, it's great to have perspective, but it also probably handicaps some of us that went through it, because we cannot help but compare this to the last time, and it was pretty dramatic, obviously. Mm-hmm. But we could not be in a more different position as it relates to housing. So I think 2007 in the metro area, we had 60,000 listings in 2007. We have never had that many listings again at no point since 2007 to the present point. So if you look at the level of inventory and then the level of pending and closed sales going into the last recession, they were so far apart. You look today, they're very, very close. We've actually done a great job at keeping our market in equilibrium. We actually have not built probably even as much as we should have for the population and jobs growth. And I think that's why you saw a lot of the price run up that you did, especially early on in the recovery. But we are in such different positions as it relates to both supply and demand. You have 250,000 more people working, hundreds and hundreds of thousands more people living in the metro area, mm-hmm. all with substantially less supply than you had going into the last recession. You don't have tremendous speculative building. And you don't have a whole bunch of bonds and loan portfolios that are about to go off with resets, making it so that people can't stay in their home and dumping additional inventory. So we could go. I could go on and on about how different this is from the last recession. There's almost nothing that's similar when it comes to real estate as the last recession, and in fact, early evidence right now, as we sort of look at how the market is behaving, shows buyers and sellers reacting much quicker to information than they were 10, 11, 12 years ago. I kind of say that we all have ADD these days, and so we want things quickly, and we move in and out of markets quickly, and when they don't meet our expectation, we get out of them. And there's this thinking developing for a long period of time, 4 to 6 months of inventory was considered a balanced and normal market. And now there's some thinking that, well, maybe it's 3 to 4. And I would argue it's some number less than that. I would argue it's under 3 months equals a balanced market today. People can make decisions quickly. They can absorb information quickly. Sellers, today don't necessarily want to sit and have their house on the market for 4 or 5 months. They want to move quick. And you saw that. We watched the weekly data coming into this. We probably withdrew, let's say, 10 to 11% of the total stock of housing that was for sale. It withdrew in the 3 to 4 weeks after the first 250 gathering order, all the way through the lockdown order. But people reacted quickly. Within weeks, pending sales dipped, and then they came right back up over the next couple of weeks. And today, pending sales are nearly equaling what they were at this same time last year with reduced inventory. I think we took almost the same number of listings as we did pending sales in the last couple weeks. So now we have a market in true equilibrium, parallel expectations. What we're putting into the market's being absorbed. So it's just, I think even the consumer is dramatically different than they were 11, 12 months ago. And I think we see that, sort of playing itself out in the data.
And what's interesting based on that is that the big difference, or at least in my world, the big difference from 12 months ago is that a lot of these lending programs have heavy restrictions right now. And so that really is showing that people are adapting, that they are in a good financial position. Not only are interest rates low, but these lenders are really placing people under a level of scrutiny to ensure that they're going to be okay if they issue these loans. So I think that that's a good testament too for the people who are in a position and can purchase real estate. These aren't people that are trying to take advantage of first-time homebuyer programs, which have pretty much gone away. These are folks that have some good assets, or they have family to lean on so that they can get into the market and take advantage of these rates, which is, I don't know from each of your perspective, but from my perspective, I think that that's a good, healthy position to be in.
Yeah. There's more equity in real estate right now than I think that there's ever been. Is that pretty much the case, Noah?
There is a lot more equity in real estate, and especially in markets that appreciated, like the metro market did here in Portland. There's been a tremendous buildup of equity, and I think you kind of have a tale of two housing markets right now, and one is the purchase market, and then one is the market for housing overall, and those are two different things. And why we see a lot of strength, I think, and a lot of resilience in the purchase market, even in the way it's reacted and in the options available to people that own or are purchasing real estate. I do think that commercial real estate or multifamily real estate is a different discussion point. But I think long run, what we're setting up for, and I think this will be some of what we look back at, the health of, Annie, is you're talking about the consumer that's purchasing real estate and the type of loans that they're getting into and the scrutiny that they're undergoing. I think you're also looking at setting yourself up for a very healthy long-term market. I think we're very focused on the short term, which is appropriate at the moment. But I also think, looking at our market long-term, I think we're setting ourselves up for a pretty healthy real estate market that remains probably somewhat undersupplied for the near to foreseeable future. I don't see us getting in a tremendous oversupply market unless we see ourselves with a whole bunch of distressed inventory, which we don't see early signs of that at the moment. Go back to duration, then that starts to matter a lot.
Sure.
Overall perspective, buying real estate on people on a daily basis, seen that much of a change even in the last couple of months. Were some periods where everybody's definitely a couple back and taking a breath, evaluate what is happening right now? Absolutely. But overall, the number of homes that we're listing, that we're pending, new buyers that we're doing consultations with and moving them through the process of what it looks like to do business in today's market. It just keeps going forward. And I think one of the things, and maybe we could talk about this for a minute, is you talked about inventory or the lack of inventory, because inventory levels are very low from traditional standards, and how that is affecting home values. Because I think, everybody that owns a home, they're wondering what their home is worth, and how is this recession going to affect their home's value. So what's the correlation there? And let's talk about it for a minute.
Well, I mean, I think the correlation between home values is really one of supply and demand. So we live in a price coordinated economy. Buyers and sellers get to coordinate on the price they're willing to pay, and the price they're willing to pay largely depends on the options that are available to them. So while we keep our market in that tight band of supply, prices are going to stay stable or continue to rise. And a lot of folks might be surprised to hear that there are multiple offer situations right now, that there are competing buyers for the same property. And psychologically, I've kind of called this a holiday market. And Andy and Annie, you guys know this, dealing with people in November and December, there are no toe dippers in November and December. You've got serious buyers and sellers in the market, and they are motivated to be engaged if they're engaged at that point in time. And I think this is a very similar market where you have very serious buyers and sellers in the market. Those that this market did not meet their expectation withdrew from the market, and you have a whole bunch of other people at the same time. And by a whole bunch, I mean like 7 out of 10 of our transactions at the moment are people refinancing their homes, lowering their monthly payment, many of them taking advantage, and Annie, you can speak to this, 15 or 20-year mortgage rates. So again, you go to speaking about building equity in the Portland market, the metro market, and then building a healthy long-term real estate market. There are some really good side notes here in terms of people being able to take advantage of an environment that helps them stay in real estate, and then also helps them build equity in real estate. So, it doesn't matter how, let's forget for a moment, just theoretically, the rest of the economy. So long as supply and demand stays within a certain range, prices will remain stable. And we see actually supply and demand where we have more demand at the moment than we do supply in some places. And so prices are stable to rising, or you have folks that are in multiple offer situations. Now, are we going to get 15% appreciation like we did coming out of the last recession? No, but we also had 30% depreciation before that. So, I mean, we have a market that's very much, I think, come back into a normal rate of appreciation. Can we, and do we at the moment, with the data we have, see 2, 3, 4, 5% rates of appreciation annually? Yes. Is that sustainable over the long run? Yes.
Yep.
So, we have thought very much as we watch the data that this is a recession, and we are in a recession and are going to go through one. This may very well be a recession that has real estate stable to climbing all the way through it. And I'm talking about single family residential real estate very specifically here, not commercial or multifamily real estate, which is kind of nice given the fact that the last recession was centered around single family residential real estate.
It was hard. It was hard. No doubt about it.
This one is not like that one. And so that is the silver lining for residential real estate, in my opinion.
Yeah. One of the things that you said was that people might be surprised that there are multiple offers. And as you were talking, I was thinking back to, okay, over our last, 5, 6, 7 sales that we've had, or 7 listings that have hit the market, about 50% of those have sold within 2 to 4 days. 2 to 4 days on the market. And several, I think 50% of those had multiple offers. One of them sold for over $17,000 over asking price in today's current environment. It's crazy. Yeah. So real estate has just kept moving forward.
Yeah, and when you put 655 new listings on and sell 605 of them, like the market did last week, that's what you're going to get.
Right.
And so until there is some large swing in supply, which I don't anticipate at the moment, until there's some big swing there, I think we're going to see stable to rising prices. And I think that this market actually has constricted a little bit of supply in probably the short and medium term. And coming out of this, we'll look back at this. The postmortem on this whole thing will probably be a housing shortage on the other side of recession. That's probably more acute than the one we were in leading into recession. That's an opinion piece. I'll come back and talk about it if it becomes true. If it doesn't, we'll never talk again.
Like what sort of a housing shortage? Can you explain just a little bit more?
Well, so now I think if we look at the market as a whole and we don't separate owning and renting, I think we see a lot of housing itself that's probably either not going to materialize or is going to go away during this period of time. And I think one of the things that you see is a lot of paused projects or a lot of caution on development or a delay in bringing certain supply to the market. And I think that duration again starts to matter tremendously, which is the longer you delay that supply, whether it be in rental stock or in readily available for purchase, I think you are going to see some constraint of supply as we begin to recover and come out of this. And then, of course, that depends on the strength of the recovery as well. But then you're also going to have a whole bunch of people that are sitting in a home that they refinanced with a 15 or 20-year mortgage at, who knows what percent. And they're going to say, I feel pretty good about where I'm sitting right now. And it will demotivate them to enter the market. And so I think you have all of these factors that come together, some of them good, some of them not so good. We'll probably see some failed development projects if this goes on too much longer. And so you'll constrain supply coming to the market. And so we already had a very healthy, competitive, robust market leading into this. I think we can now start to see some of the factors that might tell us, we may end up with a more acute housing shortage coming out.
Okay, makes sense. I want to come back to something that you said in a minute, and I made a note about new construction and thinking back to the economic forum that we went to with Pat Stone. He talked about new home buyers or first-time home buyers entering the market, and there being a little bit more inventory in that segment of the market. But before, so don't let me forget about that. Okay. But I also want to just transition into mortgage rates, interest rates, and let's talk about the mortgage market and what's happening there right now and what you see over the next 12 months, because that dramatically affects people's purchasing power and their ability to get that type of financing. So Andy, I'm going to let you run with this one.
Yeah, this is a big one right now because, as we talked about the last couple of weeks, the Fed has really been controlling where these interest rates are at. And so rates are fantastic. They were great at the beginning of this year. They're even better right now. And they should stay at these levels at least for a little bit of time. However, as banks begin to become concerned about forbearance or the potential of people defaulting on their loan, ultimately, we are going to see interest rates adjust because of that. Freddie Mac, Fannie Mae came out with an announcement stating that if folks go into forbearance immediately after taking out a loan, they're going to penalize these lenders. So in order for those lenders to protect themselves, that money has to come from somewhere, and they're going to extend it through interest rates. So we will see some fluctuations, some loan level pricing adjustments. That's the base level of where lenders price their loans at. So we will see those adjustments. And quite frankly, no matter what the Fed does with buying up mortgage-backed securities, we may see that rates come back up, to the mid 4% range, because banks are really trying to protect themselves. And it's really difficult for consumers to understand that these banks, they're really trying to avoid what happened in 2008. They're really concerned about, granted, folks, as we've talked about even today, They're in a much better equity position. They're in much better loans. We're not going to see a like for like situation, but this is unprecedented. So we're evaluating something that we've never had to experience before. And banks don't want to end up with a bunch of properties on their books like they did in 2008. So, how long these interest rates are going to be below 3.5%, that's a question that is going to develop depending on how these investors take care of it and what the government plans to do in order to keep rates low.
Yeah. So you kind of have two different tracks. You have the banks who are trying to protect themselves, and you have the government who's trying to keep rates down to stimulate the economy and the housing market, because we know that the housing market is just such a huge part of the national economy. So, like, what is the government going to do something, or how are they going to combat this? Do you know?
I don't. I mean, that's the thing, is they're already pumping so much money into these mortgage-backed securities right now, and I feel like a broken record because it's been. Well, I know how long it's been here in Oregon, but nationally, it's been 2.5 months since we've really entered into this. Everything is still so new. Just last week alone, we received a memo that Freddie Mac was no longer issuing cash out refinances, period. And then a couple of days later, they came back around and said, okay, well, we are going to do cash out refinances, but we're upping the ante on what we anticipate, how much equity we want, what the minimum credit rating is for these borrowers. And so it's just a moving target right now on what direction we're going, what to anticipate. It's almost impossible to anticipate change in the mortgage industry right now because, again, new information comes out all of the time. The amount of folks that are in forbearance, the unemployment numbers, which play a really big role on, how these investors are hedging their risk going into extending these loans.
Yeah, and the interesting thing about that is it goes back to duration and certainty again, I think. The mortgage markets have sort of decoupled from the traditional indicators that they would track along with the 10-year treasury, as a for instance. And if we use the long-term average spread between a 30-year mortgage rate and a 10-year treasury, 30-year mortgage rates today should be about 2.3 to 2.5%. So
Right.
There's already a risk premium that's been added, even at 3.25 or 3.5%. There's about a point of risk premium that's already priced in as compared to, let's say, a competing asset that you might purchase. So if we get some certainty in employment markets or in health trajectories or in economic data, and so we will surely be in a recession. Let's say that that treasuries end up then remaining low. There is some counter thought to, and the mortgage markets are so wonky, nobody knows what they're going to do at the moment. But if we had some certainty, we may also see rates fall. If we had some bedrock that we could stand on in the economy. And the flip side to that is we're pumping so much money in that deflation starts to become a serious concern. And the way you combat deflation is rates go up. So Annie, this is more your area of expertise, but I follow the mortgage markets and I've been doing this for a while. I've never seen them so weird.
No,
I mean, it is a weird place.
Yeah, it is. It's interesting because, here are the Feds saying one thing. Of course, several weeks ago when interest rates went down over that 6-day period of time and it created this frenzy in the industry. I mean, that was a lot of investors saying, holy heck, we can't handle this volume. We don't want to hire all of these people to take care of this loan volume. And stock market's declining. People aren't buying up mortgage-backed securities. Interest rates went up, almost a full % within 24 hours. So,
yeah.
And then new information is coming out on really what this means to be an investor and to be lending trillions of dollars, out, that if folks are unemployed, if businesses are going under, doesn't really matter what the government's doing in buying up mortgage-backed securities. If somebody's going to default on the loan, it doesn't do you any good if you're the one placing the risk into these borrowers. So I think really until some of that risk is minimized or there's some confidence, then we won't see things trend like they normally do.
Yeah.
Hopefully we do. I'd love to see interest rates below 3%.
Well,
it's
I suppose
crazy
if
for
they
you guys
do,
to say that out loud.
I know.
And if they do, it means that we have some good economic data, and we understand what a recovery looks like, and we have an idea of what this virus looks like in the rearview mirror.
Right.
That would probably be the only scenario in which we see that. But
Yeah.
mortgage markets are a strange place to be right now.
I can't imagine the day where somebody had a 4.5% interest rate and refinanced into 2.5 or into 3.5, and then turned right around and refinanced again into 2%. But hey, I'm here for it if it happens.
As are we. As
Right.
are we.
Crazy. So we're going to start to wrap up here, but I do want to go back to new construction just because I'm kind of a new construction geek. I grew up in the new construction business. I was in new home sales for 6.5 years. My family has been building for 30 years. So it's just interesting to me to hear from your perspective, Noah. What were the expectations going in, like at the beginning of the year, as far as new construction and maybe a little bit lower price point to help first-time homebuyers, because that is a huge segment of the buying population? And has that changed now based off of what you said earlier?
Well, there was an expectation that we were going to begin to get median or below priced new construction coming into the market. Let's say 15, 20% below the median, where you could start to get first-time home buyers into new construction. I think that inventory potential still exists in the metro market. I have no idea how builders will choose to bring that to the market. I think that there's probably a tremendous amount of discussion going on. Can those borrowers qualify today? Will they be able to purchase the product if it is brought to the market? And one of the things that we know for certain is we are still not building at the same levels that we were pre-recession. So not single family new construction, and we haven't for 12 years. At no point in time have we ever put as much new construction in a single year in the market as we did 2000 through 2007. And so the Northwest, in fact, the entire Northwest, Oregon, Washington, and Idaho are all historically underbuilt in single family residential. What we've done is put a whole bunch of multifamily into the market, something that we had not ever done before. And those people, I think, are they're going to be looking at some point to move out of multifamily rental. And if the product is there, I think the base of that is always their job, right? And the stability of their employment and the ability for lenders to underwrite them into their first home with maybe not 20% down or so. And so I think some of that depends on you could build a product, but if there's no mortgage market for that product to be sold, that could be an issue. I think the potential for it absolutely still exists for us finally to get some affordable new construction at some volume into the market. Whether that materializes given the current environment, I don't know. I think that's maybe a little bit longer term data point that we'll look to see.
Right.
Yeah.
Right. Okay. So one last thing, I want you to pull out your crystal ball. Do you have it? You have it ready, Noah?
Yep, all ready.
Okay, let's do this. So over the next 12 months, where do you see just Portland moving through this COVID, coming out the other side? Let's just pull that crystal ball out.
Well, I guess I'll just sort of hedge my bet here and say it all depends on duration. So if we can move through the current proposed reopening schedule, then I think I see us really strong in 12 months. In fact, perhaps from all objective measures, in a stronger position than we are at the moment as it relates to residential real estate, the residential real estate market. Certainly demand for it and stable to rising prices. I think if the duration goes on and on, if there's a second wave, if we aren't able to get our arms around how we deal with this, and I'm going to editorialize a little bit here. If we don't let industry decide how to reopen rather than government tell them how to reopen, I hope there's a strong partnership there. All industry has an incentive to reopen safely for their customers and for their employees. They are more incentivized than anybody else. So I think it depends on the nature of how we reopen. So that's a real hedged bet there. But I think we're going to come through it. Our economy's fundamentally changed in the last 10 years. By any objective measure, if you look at national studies, Myers Metro study, Portland is not on the watch list for short, medium, or long term. There's still a tremendous amount of growth and potential left in our market. And so I think we buck the trend and come out of this stronger than a lot of other metro markets.
I am going to agree with you because it's just in my nature to be a glass half full kind of guy. Is just who I am. We were in such a strong, good position coming into this. I truly believe that 12 months from now, we're going to be doing business differently, and we're going to be okay, and we're actually going to be better in a lot of ways. So I'm excited about the future. I can't say that I've ever been more excited. There are definitely a lot of great opportunities. And Noah, I want to thank you so much for joining Annie and I today on this show.
It was my pleasure.
Yeah, it was just awesome. So much good information, so much news that people can actually use to make smart decisions in their lives today and moving into the future through COVID. So Annie, do you want to wrap us up here?
Sure. Yeah. Well, Noah, thank you also for joining us. Really, really good information. And I think, not just from a statistical standpoint, but I think that we have a lot of really great things to learn from all of this. Unfortunate. People are coming together, the communities are coming together to help one another. And, it's unfortunate that we needed a virus in order to see that, but I really hope that is something that is able to continue, and that we all learn something from this regardless. So that's my piece.
Thank you. Thank you. Thank you. Well, if you have any questions or comments, definitely leave them on the stream. We'll go back. We'll look at those questions. We will answer any questions that you have. If you have any questions for Noah, I'll make sure that they get to him. If you have any questions for Annie or myself, we're here and we're happy to answer, and just to be a resource for you guys to make those smart decisions. So
we got a couple more weeks before things start opening up, and so hopefully people can stay safe, follow the rules, and
make it a great week, friends, and we will see you next week at 12:30. As always, have a great week.
Bye.
Bye, guys.
Bye-bye.